Hey everyone, welcome to my office and welcome to this explainer. I'm so glad you carved out the time to hang out with us today. Look, if you've been watching the markets or honestly just checking your grocery receipts lately, you know there is a lot of noise out there right now. As a financial advisor, the number one thing I'm hearing from folks sitting right across my desk is just this deep sense of uncertainty about the year ahead. And you know what? We are going to tackle that head on. Okay, let's dive into this.
So, what does this all mean? Well, that is literally the million-dollar question for 2026, isn't it? Are we heading into a recession? There is so much widespread anxiety out there about where the global economy is heading, but I'll give you the honest truth from a professional perspective. Neither I nor any economist can predict the future with 100% certainty. No way. But what we absolutely can do is build a concrete step-by-step game plan. Today, we're going to focus entirely on controlling what we can actually control. We're going to build a financial moat around your household that protects you, regardless of what the broader markets decide to do.
Here is our agenda for today's explainer. 1. The 2026 economic landscape. 2. Household budget adjustments. 3. Managing high-interest debt. 4. Expanding emergency savings. 5. Protecting long-term investments. And finally, 6. Why staying the course matters.
All right, let's jump straight into part 1. The 2026 economic landscape, understanding the macro stressors.
So, there are several specific, very real macroeconomic stressors driving market volatility right now. I mean, first off, we have a rising U.S. national debt sitting at a whopping $37 trillion, which definitely raises concerns about debt financing over price stability. We're also seeing shifting trade policies and tariffs that are kind of rewriting global supply chains. Then you've got core inflation, which is just remaining stubbornly sticky. On top of that, the whole commercial real estate sector is facing a massive reckoning as lenders finally abandon that pandemic-era extend and pretend strategy for at-risk office loans. And of course, there's the ongoing debate over whether this massive concentration of capital in AI is just a bubble waiting to pop. So yeah, your concerns about the economy, they are completely valid. But now that we see the board, let's pivot to some actual solutions.
Moving on to part 2. Household budget adjustments, defensive actions at home.
Okay, fortifying your financial baseline starts with knowing exactly where your cash is flowing. Step 1 is tracking all your spending to strictly separate the actual needs from the wants. Step 2, we've got to slash those excess subscriptions. Did you know studies show Americans are spending an average of $200 a month on streaming and subscription services they barely even use? Let's be real here, we are all paying for at least one streaming service we literally haven't watched since 2024. Reclaim that $200. Step 3, reevaluate your transportation costs. The average new car payment has absolutely skyrocketed to $745 a month. Listen, trimming everyday expenses, like canceling a few apps, bringing your lunch to work, or maybe driving a reliable used car instead, instantly gives your household breathing room. It's a pragmatic choice, right? You're prioritizing financial stability over status symbols.
But defensive budgeting isn't just about cutting your costs. It's also about your income. Relying on a single corporate paycheck in an economy where layoffs can happen completely without warning, that is a massive, concentrated risk. You need to diversify your income. So update your resume and get those professional certifications now. Look into starting a freelance gig or a consulting practice in your field. Even monetizing your hobbies can create a vital side income. It's simple. If one stream dries up, you aren't left stranded.
All right, part 3, managing high-interest debt, stopping the financial bleeding.
To get out from under that mountain of debt, you really have two highly effective strategies, the avalanche or the snowball. And this brilliantly illustrates the two approaches. The avalanche strategy is purely mathematical. You target the debt with the highest interest rate first, which, saves you the most money over time. The snowball strategy, on the flip side, is totally psychological. You pay off the smallest balance first, giving you a quick win that builds momentum and keeps you motivated. Honestly, neither is wrong. The real key here is choosing the path that you will actually stick to, so you can systematically eliminate those painful 20+% credit card rates.
Next up, part 4, expanding emergency savings, building your liquidity moat.
Look at this terrifying statistic from a 2024 Bankrate survey. 56% of Americans cannot cover a $1,000 emergency expense from their savings. Just let that sink in. If the economy takes a downturn, operating with absolutely zero margin for error is incredibly dangerous. I mean, cash is king during a crisis. We need to get you out of that 56%, and we need to do it immediately.
So, the crucial point is this number right here, 6 to 12. Standard financial advice has pretty much always told us to keep 3 to 6 months of expenses saved up. But in a high-risk, potentially stagflationary environment, that might just not be enough anymore. Our new recession prep target is 6 to 12 months of operating cash. Now, how do you actually bridge that gap? By taking the exact steps we just talked about. Set up an automatic transfer to funnel that $200 you saved on canceled subscriptions, plus 100% of the income from your new side hustle directly into a highly liquid, FDIC-insured, high-yield savings account. You just automate it, step back, and watch that moat grow.
Let's move to Part 5, Protecting Long-Term Investments, Professional Asset Management.
A well-constructed portfolio is basically a protective shield against stagflation and currency debasement. We look at different asset classes for their specific defensive purposes. Short-duration treasuries, they give you capital preservation and highly reliable liquidity. TIPS, or Treasury Inflation-Protected Securities, actually adjust your principal to directly protect against inflation. Then you've got value stocks in defensive sectors, think utilities or consumer staples, which offer pricing power and steady cash flow. And then there are alternative assets like gold or even litigation finance, where investors literally fund legal cases for a share of a successful outcome. These are super attractive because they are structurally decoupled from traditional stock market logic. Their returns aren't just dictated by whatever central bank interest rates are doing. So let's see how these assets build into an overarching strategy.
Now, what's really interesting about this strategy is how it works to reconcile your need for long-term growth with your immediate need for capital preservation. We call it the anchor strategy. You basically bifurcate or split your portfolio. You create a highly conservative core using guaranteed yields like CDs or fixed annuities, and this is calculated so that the interest organically rebuilds your entire starting principal over a set time frame. With your principal safely anchored, you can then use the smaller remaining sleeve of your portfolio to aggressively pursue growth, capturing all that upside without risking your foundation. It's a real game changer.
And finally, Part 6, Why Staying the Course Matters, Behavioral Finance in Action. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." And isn't that the truth? When markets drop, the emotional urge to panic sell is intense. I get it, you just want to stop the bleeding. But history shows us over and over that investors who abandon their long-term strategy during transition phases almost always lock in their losses, while the patient investors eventually catch the recovery wave.
I really want to hammer home the staggering statistic to prove that point. Over a 40-year period, missing just the 10 best performing days in the market reduces your final accumulated wealth by approximately 54%. Think about that for a second. Over 4 decades, missing just 10 specific days literally cuts your wealth in half. And those best days almost always occur during or immediately after periods of intense market volatility. Abandoning your plan is, for sure, the single biggest threat to your portfolio.
Well, we've covered a lot of ground in our explainer today. We mapped out the macro risks, restructured the household budget, attacked the high-interest debt, expanded those cash reserves, and fortified the investment portfolio. Now the ball is entirely in your court. So what is your first step today to build your financial resilience? Pick just one thing we talked about. Cancel a subscription, check your savings yield, or review your resume, and just do it right now. Economic storms are inevitable, but participating in the panic, that is entirely optional. So which side of the financial moat will you be standing on when the rain starts? Thanks so much for joining me today, and I'll see you next time.